Welcome back to the channel. So I'm going to share an indicator that I personally use. It's super successful. It's not mine. I'll explain where it comes from, but it triggered on Friday when we saw the SPX take quite a tumble here, right? I mean, basically closed over 2.5% lower. And as you can see on this chart right now, I have all these arrows here. This actually shows you all the previous times that this signal has triggered, and we'll quickly go over all of that. But first, let me explain what it is. So it does come from a different service. It's called Volland. They essentially track all the option data out there. We're specifically looking at SPX data here. And this is a regression chart between SPX and VIX. I believe they track, I believe basically over the last 6 months or so, the relationship between the two, because obviously there is an inverse correlation between the SPX and VIX. Everybody's aware of that. Sometimes the correlation is stronger, sometimes it's a little bit weaker. Either way, it is, we have the chart for it. Now, there are days when VIX moves a bit more aggressively than it should be, and some days VIX does not move as aggressively as it should be, right? Think about the days when we kind of see that the market's down a little bit and VIX is actually also a little bit down, right? That would be referred to as under-VIXing, or vice versa. Maybe the market is up, but VIX is also up on the day, right? That would be referred to as over-VIXing. Obviously, the relationship there is kind of breaking the other direction. VIX might be too aggressive, or might not be as aggressive as it should be. Well, on Friday, we got a situation where VIX was way more aggressive than it should have been. Yes, the markets came down quite a bit here, but based on the fact that VIX was up 6 points, over 6 points on Friday, it did not warrant the move that we saw on Friday. Basically, VIX went up way more aggressively than how we saw SPX drop. And usually, so in the Volland software, even though it's the weekend now, but what would happen here is it would actually show us that we are over 2 points over-vixed of what was expected based on the regression chart. And once we close at that 2 points higher than it should be, again, we're specifically talking about the fact that, as you could see here at the top right, it says right here, VIX was 6.11 points up on a day. If we compare that to the percentage that SPX was down 2.64%, right? There was a number. So let's say that number was something like that VIX was expected to be up 4 points in that day, based on how it's traded for the last like 6 months. Well, if there's a over 2 point difference between what it should have been and what it actually was at the close, it triggers this indicator, basically telling us that into the close, the market is more hedged than it should have been for this drop, which is what we got. Now, when this shoots off, when this indicator shoots off, there's a time clock of about 3 weeks, that in 3 weeks, the market will reverse the loss that we saw on that day. Meaning, right, so here's a loss on June 5th. The market would essentially come right back up to this level, the previous day close, right? The previous day close in this case, that's about 75.86 or so. If we look, let's look at the previous times that this has actually occurred, right? So this was during the drama with Iran, okay? So the previous time this went off, March 27, okay? This was the day it went off. We saw this drop here. How much of a drop was this? This was about like a 1.5% drop, a little bit more. Notice it didn't go off on any of these other drops. It went off on this particular drop that day. We did trade slightly lower the following day, which is why I want to say the path is not guaranteed. It doesn't mean we go up tomorrow. But when the indicator shoots off, in my experience from trading this over the last few years, there's over 95% chance of it working out, but it takes up to 3 weeks for it to work out. If it takes longer than 3 weeks, it's considered to be a failure. And we'll go over one of those when it did fail. It took a little bit longer than 3 weeks. But it went off here. Now, the moment this candle here basically satisfied the signal because we got above this high, above this close. You see that? So this was satisfied within 2 days. It shut off again early on during the drop. And now, by the way, the the size of this candle is everything because I'm kind of zoomed in. Some of it looks like it's kind of like sideways, but the ranges are pretty big here. It shut off on this candle, okay? Within 2 days, it was satisfied. Notice what happened here actually. So a day passes, we trade a little higher. The second day we trade higher, we actually satisfy. Notice we go above that close, and then we close lower and we go lower, okay? I kind of expect something similar to happen this time around too, where we satisfy the overvix signal, we get back up here, and then we roll over again. I see that happen quite often. Now, before then, so this was successful. This was successful. Very quick satisfactions of those. This one, January 20th. We basically traded up right away. It took us a few days here. It was satisfied. I think it might have even been satisfied in this candle right here. Yeah, so 2 days, 2 trading days, it got satisfied. Let's go back up. This is October of last year. So this time it triggered twice, very close to one another. Triggered off this candle. We traded a little bit sideways, triggered again, and then both ended up being satisfied pretty soon after. Before then, this one got triggered. We traded up right away. So this one got satisfied within a few days also. So a lot of these do work very, very quickly. This wasn't a big win, but this is also a day where we got triggered, right? I mean, how much of a drop is this? Barely over 1% drop, and it pretty much took, again, under 2 trading days for it to be satisfied. Okay, let's go to the tariff crash from last year, okay? That's a big one, okay? That's a big one for us to look at because one of these failed. So, notice throughout this whole drop of the tariff crash, we never get the overvix signal happening. Now, let me say this much. On down days, like these big down red candles, we are overvixed. Again, when I say overvixed, it means we are over 2 points more vixed than we should be. And very often on bigger red days, bigger basically meaning anything over 1% drop, we are almost always overvixed out of the gate when the market opens up. Which is why kind of often we kind of see a rebound happen throughout the day and the buy the dip comes through because we essentially have a lot of people loading up and then buying puts and SPX and ES and so forth. But when the day gets really bad and there is no rebound into the close and we end closer to the lows and VIX stays elevated, that's when we have a chance of that overvix signal popping off. Because very often we sometimes come off 3 points over VIX, 4 points over VIX early in the day, but then by the day end, the market bounces a tiny bit and VIX dumps a lot. That's what often happens. The VIX dumps a lot from those early high levels. If we just kind of look at the chart here, I mean, let's just try to pick a date here, right? Just so I can show this to you guys, as often what happens. So if we look at, let's say we look at this candle, I'm just trying to find a good example here, like this candle right here, right? On the 5th, right? So we drop lower. How much of a drop was this? Over 1% drop. We were down as much as 2%, right? This red candle right here. But if you notice, this is the day. Look at this. VIX really did go up, you know, a couple extra. Look at this, over 4, up to 26. It was at 26, but then it closed the day at 23. It shed off 3 whole points throughout the day. Even though the market closed, you know what? Okay, we closed about 70 basis points from the lows. But very often that's what happens. You end up getting these massive wicks. See these massive wicks on VIX here? This is a very common theme where you get overvixing happening intraday and then it doesn't stick by the close. Or it might only be a point over VIX or 1.5 over VIX and so forth. During the tariff crash, it only officially overvixed for the first time on April 3rd. This was basically Wednesday after the market closed. If you guys remember this is when Trump came out and had the reciprocal taxes and so forth. The futures market obviously dumped. The day opened up. This is the intraday of the S&P 500, so it doesn't track the overnight move here. The market obviously gapped lower. VIX exploded. We triggered over VIX here. We triggered over VIX the following day. Okay, now look at what happens here. For starters, it would have gotten you in at around these levels here. The market's, so if you got into this overvix here at 5,400, the market still traded lower by quite a bit, right? That's the path that I'm talking about, 10% lower. So if you leveraged your ass off, you would have gotten liquidated because the market still managed to trade 10% lower within 2 days here. If you got into the second signal, the market still traded over 4.5% lower. So again, even super leveraged, you would have gotten liquidated here. Okay. Now, with that being said, if you had a strategy that maybe you were targeting, you had an option position, maybe some debit vertical spreads, call spreads, expiring a few weeks out, and so forth, maybe you're not as worried about this. Because here's what happens. So the market bottoms, it has a massive rebounding day. This signal satisfied, that is it. Notice we're above this close, right? So this one gets satisfied, but this one right here, which would require a move of us going all the way back up here, right? That's what, to satisfy this overvix, we would have had to gone all the way back up there. Notice it gets up there, but it takes way too many days to do that. Because if we go from it being triggered there and we start day one from over here, how many days is that? This is 28 days. It took 28 days for it to be satisfied. So it still got satisfied, but it took way longer than it should have. Not should have, obviously. The signal is going to fail at times. That's the point. Obviously, there's a lot of news coming through around this period, whether or not the tariffs are going to get worse. You know, maybe this could have been us rebounding and everything would have been great for us, and maybe some more negative news about China really came through, which it kind of did during those times. I mean, headlines were super big back then, but it failed there. Okay, it failed there. So this is the one failure I could show you in the last year that occurred with it. But I've been trading this signal for 2 years, myself at least, and the person that created the signal itself and runs Volland, I mean, he's been trading it for over 10 years. And he has seen, I think it was either 2 or 3 losses out of like 35 instances, okay? And one of those losses is this one, okay, that it took too long. So it is a very high successful signal, but the path is not guaranteed. And I have to stress that because it's very easy to kind of have an idea of where the market could still go 3 weeks from now and still lose a lot of money if you're not properly positioned for it. And I also believe that because we triggered an overvix on Friday, and from memory, I believe that overvix was over 3 points, which is good. Obviously, the bigger the overvix, the better it is. And just looking at the option positioning here, so these are a lot of puts that were purchased. These puts actually expire. This coming week too. Now, VIX, normally speaking, is not affected by puts that are purchased in the next week. Usually it's the puts that are calculated like 25 days out, like 40 days out or so forth. But we still saw a lot of puts being purchased this coming week here, which does give us a lot of fuel, because obviously if all these puts are being purchased, market makers do have to go short futures to hedge these puts, especially as they went all of them went into the money, and the markets moved very quickly and very aggressively on Friday. At the same time, that also gives us fuel to unwind all of them, because obviously once we start building and pushing all of these puts back out of the money, market makers have to unwind their hedge, meaning they're now buyers in the market. They don't have to be as hedged as they were before. If volatility comes down a little bit, market makers also do not have to be holding as much futures as they currently holding, because obviously as volatility goes up, it also means that any other puts that are being purchased outside the money also require them to have more deltas on them. So in my opinion, playing long from here is going to be the move. I also have an inkling here that we will see a quick move higher, a satisfaction of the overvix signal, and then possibly a failure. Yeah, that was more of a crapshoot, whether or not we failed afterwards. Okay, I've just seen that happen multiple times before, because there might still be. Let me say it this way: the move lower could be valid in the sense that maybe there's cracks on the surface, and the market's going to roll over completely. So I'm not disputing that. that maybe there are now cracks in the service. There's other things I could point at to show that, right? Especially just the overall option positioning for the last week of June, which is OPEX, and even for the whole year, all that still looks bearish. So I can show you a bunch of stuff that still looks bearish, but we kind of got a little too crazy on Friday with how VIX moved. So I think this kind of needs to mend itself first. We need to melt VIX down a little bit here, because you'll see that if that happens and then we start rolling back down again, we are not going to have VIX being as aggressive as it was on that particular day, right? So again, I'm kind of looking for something like this. Well, we see we gapped lower, finished lower, we over VIX, we came up, satisfied it, rolled over, and then we did not have an over VIX come up again until pretty much the very bottom. I mean, if and I played this, by the way. So if you play the over VIX signal right here at the bottom of the Iran drama, you made like a bandit. I mean, look at this. It pretty much, you took in one more day of down draw of nothing. I mean, how much of a down draw is this at the very worst? Okay, well, you know, I guess again, the candles are a little bit shrunken down here, but okay, you took under 1% of down draw on the indexes, and then it just shot forward, right? So this is what I'm looking for. Again, it's not a guarantee. It's just a high probability outcome. If you have any questions for me, just let me know in the comments below. Other than that, throw me a like, subscribe for more content like this, and thank you for watching.